It's Rebecca Maxwell-Hislop. I am a financial planner and I work with women like you to make better financial decisions. This is my second career. I was a trader in the city for over 20 years and I moved into personal finance almost 3 years ago. It's an area that I'm hugely passionate about because I see so many people who are managing their finances really well on a day-to-day basis, but they are not doing enough to put plans in place for their future. And having plans in place gives you choices further down the line. I'm often asked, so what does a financial planner or financial advisor actually do? Got a little thing here. We hear the term, but what do you actually do? And I would say it's a hugely personal relationship. Sometimes the relationship I have with my clients, they share things with me that they don't share with anybody else. And it's very much getting to know the individual, getting to know the individual's personal circumstances and their business circumstances, working out, looking at their assets, the assets that they've got now and the assets that they may have in the future, and how they choose to use them. I specialise in goal-based financial planning. So that is creating a roadmap, working out, what it is somebody wants to plan for, whether that's buying a house, potentially funding university fees, being able to afford to drop down to 3 days at work, or the ultimate retirement planning, of course. And financial planning can be complicated and it can be onerous. And in a world where legislation changes and personal priorities change, it is really important to keep reviewing that financial roadmap and making sure that it works for you. An important part of that financial roadmap is building tax efficiencies into this plan. We are taxed. It seems that we are taxed at every opportunity, on income, on capital, even sometimes when, on death, when leaving an estate to loved ones. And today I'm going to talk to you about tax planning and some key steps that you can take even before the end of the financial year, which is 34 days away, that can result in either mitigating or reducing some of the tax that you are paying through the use of various reliefs or allowances. All of these are so important, and combined, using your tax allowances efficiently, combined with effectual financial planning and advice, helps you to create a robust financial future. I want this to be, as I mentioned earlier, I want this to be an interactive session, and there will be an opportunity for questions throughout the hour. And as always, I'm very happy to offer a personal financial health check afterwards. Get in touch with me, and I've done it with many of you, and many of you have found it hugely valuable. So we're very, very happy to offer that, and I think it's very important too. Still trying to work out how to do these slides. As Mark rightly got the strap line, use them or lose them. Many of the tax allowances, if you don't use them before the end of the financial year, you will not get an opportunity to use them in the future. I think it's really, it's really important before looking at tax allowances is to look at your own personal situation. Even just sitting in the room, people are sitting in very different situations. There might be those who are basic rate taxpayers, so on any income tax, they pay 20%. They may be higher rate taxpayers, so on any income, they pay 40%. Or they may be additional rate taxpayers, so on any income, they pay 45%. So we are all exposed to tax in different ways. There may be some of you who have sold an asset this year and will be exposed to capital gains tax, or others whose perhaps your family's exposure to inheritance tax is weighing heavily on your mind. So it's really important that before you do tax planning, you do look at your own personal situation, and then you look at the allowances that are available to you. And once you have used those up, then perhaps you can look at more complicated tax planning. There are various investment structures which are tax reducers. They carry a higher level of risk, but again, that is more complicated. Stick with the basics first, get to grips with the basics, and then you can move on to the more complicated things later on. So sticking with the basics, we're going to start with ISAs. So ISAs, individual savings accounts, these were launched in 1999, and there are currently 4 types of ISAs. There are cash ISAs, which is in effect, it is cash in the bank. There are stocks and shares ISAs, innovative finance ISAs, which is peer-to-peer lending. And then there are the newer lifetime ISAs. Lifetime ISAs are brilliant if you are looking to buy a house in the near term, although there is a price cap of 450,000, which sounds an awful lot as a first-time buyer, but in London, 450,000 doesn't get you an awful lot. And that's whether there's 2 people buying the house or whether there is just 1 person buying the house. From all ISA subscriptions from 1999 to 2019, 81% of those were in cash and only 19% of those were in stocks and shares. The question is if you are using this allowance, now every adult has got £20,000 a year that they can put into an ISA, which you can only, if this is an allowance, and if you don't use it in this tax year, you will lose it. So the question is, if you are putting your money into a cash ISA, what are the returns that you're getting on that cash ISA? And are the returns keeping up with the rate of inflation? If they're not keeping up with the rate of inflation, then the purchasing power of your money is receding every year. And I think, you must have had your head in the sand if you haven't heard, inflation is rising at the moment. There's been talks of 4%, 5%, even 7%. So actually money kept in cash, the real value of that money is could be losing up to 7% a year. Also important to think is using your ISA for cash, the best use of it, because there is a personal savings allowance. Now, anybody who is a basic rate taxpayer has a personal savings allowance of £1,000 a year. A higher rate taxpayer has a personal savings allowance of £500 a year. That means money in the bank. If you're a basic rate taxpayer and you are getting 0.45% on your money in the bank, you can have 222,000. So yeah, just over 222,000 in the bank and not have to pay any interest in it. It's half the amount for a higher rate taxpayer. Sadly, additional rate taxpayers don't get this allowance. So that's an awful lot of money in cash you can have before you pay any tax. So, really consider again whether the 20,000 allowance, using that for cash, is the best thing for you. Keeping cash is important to any financial plan. And I always talk to my clients, I always run my clients' money the same way that I run my own money. I do have a large emergency fund, and I think that is important because we never know what is down the road. And I recommend that my clients have 3 pots of money. The first pot being their emergency pot of cash, the second pot being any planned expenses in the next 5 years. So if you look to buy a house in the next 5 years, you're looking to buy a car, a new puppy, anything like that, then you keep that money in cash as well. You just have to look at the volatility of the markets to know that the last thing, I know I was talking to somebody last year and they had all of their money invested in the stock markets for a deposit for their flat. We all know what happened in March 2020 when the bottom fell out of the market. They had to delay the purchase of their flat because they had lost a lot of their deposit. Thankfully, the markets did come back, but that is an example of if you know you're going to use that money, it is unwise to have it invested. And then the third pot of money is that that is the long term. And that is, split that into different savings pots. You might use some for your pension, and ISA is where you might use something else. And using a stocks and shares ISA does not have to contain stocks and shares. You could use a collective fund and have property funds in there. You could also have bonds in there as well. So the stocks and shares ISA is an ISA, but it's just not a cash ISA. And then any money, any income it generates and any capital it generates will be tax-free. It will form part of your estate for inheritance tax, but we're all young in the room, and we're going to be concentrating on income and capital at this moment in time. Along the lines of ISAs, there is also a junior ISA. Every child can have £9,000 invested in a junior ISA per year. Now, this can be given to a junior ISA, called a JISA, has to be set up by parents, but anybody can contribute to it. Now, this is a great way for parents or grandparents to pass money to the next generation. Just things to note is that children do get control of their JISAs at 18, so you have to be happy for them to have that control. And one thing that I do always say to my clients are, make sure that you've looked after yourself first. Everybody, we all put, as a mother, I know I've got 3 children, we all put our children first. We all do. Actually, gifting money to your children before you've looked after your own pension provision is not a good idea. Once we have, outside an ISA, there are other and personal savings allowances. There are other allowances that are available to you. Can I ask, does anybody know what the capital gains tax exemption is? The annual capital gains tax exemption is? Anyone writing it? Anyone going to be brave? And actually, when I speak to people, this is something that, 10 grand, not far off. It is actually 12,300 a year. So this is another gain that you can crystallize every year before you pay tax. And when I'm doing personal health checks with people, this is something that quite often isn't on their radar. So you could use that for direct equities or unit trusts. It's also, you've also got a dividend allowance of £2,000 per year. Everybody, no matter what tax band they're in, can earn £2,000 worth of dividend interest per year before they start paying tax. A lot of company directors pay themselves a lot, in dividends because of that. You get the £2,000 exemption, and then if you're a basic rate taxpayer, you're paying 7.5% on your dividends. If you're a higher rate taxpayer, you pay 32.5%. And then if you're an additional rate taxpayer, you pay 38.1%. It is going up slightly after April. But again, are you using your dividend allowance? Investment bonds are a great way of deferring tax. I'm not going to touch on those much. They are used a lot for inheritance tax planning. Again, if that interests you, get in touch. We can talk about those in more detail. And another, the big one on here is pensions. Now, pensions are just an investment with a tax wrapper. And to incentivize people to save for their future, the government gives generous tax allowances. On to pensions. So saving for a pension is hard, but retiring without a pension is a lot harder. And I think very often it's hard to think, it's hard to imagine yourself old. It's so easy to concentrate on the now and not the future. But, think about your future self. Think about all that free time. You are not going to thank yourself if you don't have any income, or if you are relying on the state pension of £9,000 a year, if indeed that still exists when we all retire. I think a lot of things that people underestimate is the longevity. You look here, the UK life expectancy for 65-year-olds. So when you get to, in 2037, women are expected to live for think it's about until they're 87, and that's increasing to over 90 in 2062. So how do you fund a retirement that could actually be longer than your career? Longevity is how your pension pot is going to last you from retirement until death. That is something that is hugely underestimated, and the situation is not getting better. Longevity, they think a baby born in 2020, a third of children born in 2020 will live to 100. So funding the 100-year life will be getting more and more common. All of that, due to the better standards of living that we all have, improvements in nutrition and medicine, means that everybody is living longer. And this shifting demographic means that there is going to be a shrinking workforce and a larger older population. And it makes you think, how is the workforce going to pay for the older generation state pensions? And is a state pension for all? I have to say, I think we're probably on limited time with that state pension for all. At the moment, as long as you've got 35 years of national insurance contributions, you are entitled to a full state pension, which is just over £9,000 a year. But I would be amazed if that lasts. I'm 49 now, so retiring in just under 20 years. I would be amazed if that is still around when I come to retire. And there's a lot of you on the call who are far younger. So it just really emphasises the fact that making personal provisions is even more important than it's ever been. Pensions are complicated. So why should we save into a pension? As I mentioned before, there are really generous tax reliefs on contributions. And the tax reliefs are, then grow really tax efficiently. Current legislation means that once you get your pot of retirement, you can take out 25% tax-free, and then the rest you draw as income and you pay income tax on it. There have been a lot of changes, a lot of reforms in the last few years, which haven't all been bad. The fact that you can now draw down your pension and use it as a flexible fund is really useful. And it also means that passing it on to the next generation can be really tax efficient. Your pension sits outside of your estate. And if you die before the age of 75, then your pension passes to your beneficiaries tax-free. After the age of 75, it passes to your beneficiaries, but they draw it down as a pension. So they draw it down at their nominal income, their nominal rate of income tax. So people do use that for inheritance tax planning as well as pension planning.
Rebecca, so beneficiaries, then, is that beneficiaries as named in your will or your next of kin and spouse?
Beneficiaries for your pension, with your pension, you should have a letter of wishes.
Yeah, okay, yeah.
And your letter of wishes can be who you like. However, it is always at the discretion of the trustees. So a lot of the time, the beneficiaries are those who are named in your will. If you were to suddenly meet someone tomorrow who held a gun to your head and said, make me the beneficiary of your pension, on death, the trustees might look at this random beneficiary, and if it doesn't make sense, then they can overrule it and give it to your next of kin or your children, your wife.
Okay. So let's roll the clock forward a few years. I've retired. I've got a pension. I die. What is it that my beneficiaries will receive?
It depends when you die. Just for easy maths, you've taken the tax-free cash from your pension. You've got a residual balance in your pension of 100,000.
Yep.
Okay. If you die before the age of 75, then that money can go to your beneficiaries tax-free. 100,000 could be divided between Tina and the various children. After the age of 75, then that pension pot will remain as a pension pot, and it will be drawn down like you were drawing it down. So income tax would be paid on it.
Okay, but when you say drawing it down, so the beneficiaries will get a monthly sum.
If that's how they want to draw it down, yes, they can have a monthly
but
sum.
For how long?
Until the pension is. This is as long as this is if you have got a money purchase pension, not a final salary pension, not an annuity. If it is an investment in a pension wrapper, so until that pension pot is exhausted. So if you left it to children, for example, they might choose not to draw, and they were higher rate taxpayers. They may choose not to draw it down until they were of pensionable age, and they were perhaps a lower rate taxpayer.
Okay.
Does that make sense?
Yeah, it does. Clearly, by asking those questions, I'm showing my age, aren't I? I care about ISAs and pensions.
Really important. I want everyone to care about their pension.
Yeah.
Contributing to a pension is also a really good way of bringing down your adjusted net income. Now, I don't know how many of you have got children and how many of you are claiming child benefits. If you earn between £50,000 and £60,000 a year, then your child benefit is reduced by 10% for every £1,000 you go over 50,000. If you earn, say, £55,000 a year, then your child benefit will be cut. You'll get 50%. However, that £5,000 over 50,000, if you were to put that into a pension, that brings down your adjusted net income, and then you would re-qualify for the full amount of child benefit. So pensions can be used in that way as well. I've got a client, he's a doctor, and he was earning he's got 3 children, he was earning high 40s. In COVID last year, he was called up, so he was qualifying for the full amount of child benefit for his 3 kids. And during the COVID crisis, he was called in, he had to do so many extra shifts just to help out. And his salary then went from 48 to 62,000. He was so tied up. I'd warned him about this, but he was so tied up in the moment and just survival mode, and who can blame him? So once his salary got to 62,000, he's had to pay back all his child benefits for 3 children. But had he contributed £12,000 gross into a pension, then his pension would have benefited from the 12,000, and he would have had his child benefit reinstated. Just a little useful tip there. Child benefit looks at both partners' incomes. Yes, it does. If either of you earn more than £60,000 a year, then you are not entitled to child benefits. Whereas if both of you earn under £50,000 or in between, then you are. It's quite an unfair system. So you might have a single parent earning £61,000 and is not entitled to any child benefit at all, but you might get mum and dad living together and they both earn 49,000, so a lot more than 61, and then they are entitled to the full child benefit. Yes, it does. It includes all income. So if you've got your salary, your bonus, if you've got a buy-to-let, for example, or if you've got a really profitable investment portfolio, that could also be used as income. What if one is a higher earner and the other one is not? If one of you earns more than 60,000, then you do not qualify for child benefit. If one of you is I'm just thinking about the room, if one of you is a higher rate taxpayer and your spouse is a stay-at-home father, then you can claim child benefits, but you would have to pay it back. But the benefit of claiming the child benefit is you will, up until the child is 12, you will get national insurance credits that work towards the state pension, if the state pension is around in that many years' time. But it's a case of claiming the money, paying it back, but you've got national insurance credits. So I do advise doing that, as long as you remember to keep the money safe, and you will have to pay it back. That is another way. That is another benefit of child benefit. I've talked a while ago on my LinkedIn, I don't know if any of you follow me on LinkedIn, again about this adjusted net income, that there is a 60% tax sinkhole for those earning between 100,000 and 125,000. Anything over 100,000, you start losing your nil rate tax band, which is just over 12,500 a year. So once you get to 125,000, you no longer have an income tax nil rate tax band. So in effect, your income between 100 and 125,000 is taxed at 60%. If you were to contribute your income over 100,000 into a pension, just say you earn 115,000, you've lost 2/3 of your nil rate tax band. If you were to contribute that 15,000 gross into your pension, then you will benefit from getting 15,000 in your pension, but also regaining your nil rate tax band. So another way that pension contributions can be useful. So how are we doing for time? Oh my goodness me, we are really, let's race through. So the allowances have changed. Governments have cut back on the amount of money that you can pay into a pension. They want to make it a level playing field. They don't think, some people don't think it's fair that higher rate taxpayers get a higher rates tax relief on pensions. It is currently, you have £40,000 a year annual allowance compared to a pension. It's capped at 40,000, the higher of 40,000 or your income. So if you earn 20,000 a year, you're capped at 20,000. This can be carried back for 4 years. So if you haven't maximised your pension, then you use this year's first. And then, for example, some directors of limited companies, they don't have to be putting money into your pension. Sometimes if they have a particularly good year, they may catch up and they can potentially put 140,000 into their pension. 160,000 into their pension at one go. Higher earners get their pension allowance tapered. Once you earn over £240,000 a year, then your pension allowance may be tapered down to £4,000 a year. And the other thing you need to look at with pensions is your lifetime allowance. Most people have got a lifetime allowance of 1.0731 million. This sounds an awful lot. However, allowing for growth, allowing for, many of you are 20 or 30 years away from retirement, this is something to keep half an eye on as well. And it is not just people who are approaching retirement who need to look at this number. We thought this would increase with inflation. However, in the budget in 2021, the Chancellor announced that this 1.073 million was going to remain static until 2026, which means there's going to be more people having pensions which are higher than this, and they will incur a lifetime allowance charge. As I said, it's not just people who are approaching retirement now. If you are a high-earning 40-year-old with 300,000 in your pension pot, you have to really weigh up the fact of how much should you be putting in now. If you think your income is going to go up dramatically and you're going to start losing the ability to pay money in, then it is worth putting more in now. But if it's not, and with your work and with your company putting money in, you putting money in, it's really important to speak to somebody, get advice about this, so you don't lose out on the valuable benefits, but neither do you incur tax charges down the line. Again, it's all about being informed. And like JISAs, you can actually put money into kids' pensions. It's another really tax efficient way of saving for children using the allowances. And you can get, if you put £2,880, you can put £2,880 a year into a pension for a non-taxpayer, and that benefits from 20% income tax relief, making that 3,600, actually 25%. It looks like the math doesn't work, but it does work. If you're really worried about it, I can tell you. And this is also important if you've got a non-working spouse. A non-working spouse could have 3,600 gross put into their pension every single year, and you'd only contribute 2,880. So again, this is a good way of grandparents saving for children And parents also save with children. They can't touch the money until they're in the late 50s, but if you can afford to lock it away, again, another great allowance that can be used. I'm conscious we've got 9 minutes left. Are there any more questions about pensions at the moment? So the 4 pillars of tax efficient investing. We've spoken about ISAs, we've spoken about pensions. I'm just going to touch on VCTs and EISs. We hope to have Debbie from Octopus Investments coming and giving an in-depth talk about VCTs and EISs, because I know that's something that the E2W community are really interested in. And these are tax efficient investment schemes. VCTs, venture capital trusts, EISs are enterprise investment schemes. They are higher risk, but they do come with great tax advantages. It is all about investing into startups and new ventures in the hope that those that succeed will be employing people, and they in turn will be generating income, which will then pay the government lots of tax. So the government are happy to give the tax incentives early on in the hope that down the road, in fact, they'll get that back and more. Again, it's a higher level of risk, but it's really important. It's really important to consider these, especially with the amounts of pension allowances decreasing all the time. The allowances for these, again, just really, really quick overview. They're not for everybody. They are higher risk. It's just, it's good to have these in the back of your mind. They are, if you are to invest 30,000 in either of them, then you get 30% back as a tax reducer. So if you were to invest 30,000, then you would get £10,000 off your tax bill. You have to have a tax bill. You have to have paid that amount of tax. So you can't be a non-taxpayer and get £10,000 back. There are various, ifs and buts, and, different holding. A VCT you have to hold for 5 years. EIS you have to hold for 3 years. The allowance, you can put 200,000 a year into a VCT. You can put $1 million into an EIS, or 2 million if it's a knowledge intensive company. Lots of other benefits to them. EISs, you can roll over any capital gains. VCTs, the dividends pay out tax free. So a lot of people like to use those VCTs for retirement planning, to create another tax-free income. And EISs, people use those if they've incurred a capital gains tax, for example, if they sold a second property and they invest the money, and then they still have to pay the capital gains, but they hope that the capital gain will actually increase, and so they will profit from it. Anything else? Should we just quickly move on to inheritance tax? As I said at the beginning, everybody is sitting in different places, and you may be concerned about your family's inheritance tax liability. Everybody in the room is young, but really want to stress the importance of having a will, having a valid will. So if you were to die unexpectedly, then your estate does get passed in the way that you would wish, and not through the rules of intestate. But it is really important as well to engage with your parents and engage with your grandparents. There is nothing wrong with this. It's not greedy. It's just to make sure that your parents and grandparents have the information at hand. And if they choose to mitigate inheritance tax, they know there are options out there, often described as a voluntary tax, but it does involve some sort of planning. Oops. So how much can you pass down to your beneficiaries before you pay tax? I'm sure you've all heard £1 million nil rate tax band. Yes, it's not quite as simple as that. Why does that not surprise you? Everybody has got 325,000 nil rate tax band. And then on top of that, there is 175,000 residence nil rate tax band. So long as you have got residential property, your primary residence, that is worth at least 175,000, and it passes to direct descendants, so children, grandchildren, stepchildren, adopted children. If your estate is large, then your residence nil rate tax band, it is tapered. But again, too much detail for now. Otherwise, the exemptions, anything could be passed into spouse. There are certain investments you can do which mean that they are exempt from inheritance tax. Business relief is one of those. How can you bring down the value of your estate? A lot of people use trusts. I'm not going to go into trusts today. Valuable way of inheritance tax planning. I'm sure you've all heard of the 7-year rule for gifts. So if you gift something, as long as you survive 7 years, there's no inheritance tax to pay. Broadly speaking, no surprise, there are a few ifs and buts. And it does mean that, I think after 3 or 4 years, the amount of inheritance tax that you pay on that gift is tapered down. But there are also some exempt gifts, which is what I'm going to concentrate on today. Right, small gifts, you can give £250 to anybody, as long as it's not combined with any other gift. The annual gift, now these gifts look quite small, but actually they add up. You can give £3,000 tax-free per financial year to anybody you want to, and this can be rolled back 1 financial year as well. So now if you haven't used that allowance, you could, or your parents or your grandparents could give away £6,000. There are wedding gifts, you can give up to 5,000. But one of the things that people don't think about is gifting from regular income. If you've got an excess of income and it's not going to affect your day-to-day life, then you can, parents and grandparents, if they've got an excess of income, it has to be income and not savings, they can give that away. Inheritance tax, you need to be domiciled in the UK. That is more complicated. Let's take that offline, because it depends how you are resident, and sometimes it will be on your worldwide assets, sometimes it will be on your just on your UK assets. But passing into spouse, if you are domiciled and your spouse is not domiciled, then you can't pass your full estate to your non-domiciled spouse without any tax charges. So in summary, tax allowances, use it or lose it. The questions are: ISAs, are you making the most of this year's £20,000 ISA? And can you also consider contributing into a junior ISA? Are you using your personal savings allowance? Perhaps not having all of your money in cash ISAs because you have got this personal savings allowance of up to £1,000 if you're a basic rate taxpayer to use. Pensions. And I will say with pensions, are you maximising, if you're working for a company, are you maximising any of the matching that your employer will give you? That is in effect free money. So really do look at that. And if you have excess money, excess savings, you can put that into your company pension, you can put that into a private pension as well. Really worth looking at that because there are huge tax advantages. Capital gains tax, again, something that a lot of people aren't using. Are you, and if you've got a portfolio, you can switch funds, and so you are actually liquidating those, you are crystallizing that capital gain as you go along, because you can't just catch up on 5 years when you sell it. And it's working out, if you've got a whole portfolio of buy-to-let properties, maybe not selling them in the same tax year, because you've only got 12,300 allowance. Oops. Dividends, are you using your £2,000 dividend allowance, or could you be? And then inheritance tax, are you thinking about your own inheritance tax planning, or more importantly, your parents and your grandparents? Or, is HMRC going to be their favourite child when they die?